Hey everyone, and welcome back. You know, I get it. We all want to build a solid financial future, right? And one of the most powerful tools we have at our disposal is something called compound interest.
It's been called the eighth wonder of the world for a reason.
It really is amazing when you stop and think about it.
Absolutely.
And today we're going to do a deep dive into this concept. And we're going to use an excerpt from a great book to guide our conversation. The book is called The Power of Compound Interest: How to Turn Small Investments into Millions by 2040.
Kitschy title.
It is, right. It really grabs your attention.
It does.
So in this deep dive, we're going to break down exactly how compound interest works, look at some real-life examples of its potential, and of course, give you some actionable tips to harness its power for yourselves.
Sounds like a plan.
Awesome.
Mm.
So maybe let's just jump right in. Could you maybe start by breaking down for us what compound interest actually is? Because to be honest, I think a lot of people hear the term and they kind of glaze over.
It sounds complicated, right?
It does.
Yeah, it's understandable. It's one of those financial terms that can be intimidating.
Yeah.
But at its core, compound interest is really just interest, earning interest. It's like a snowball effect. Yeah, imagine you're rolling a small snowball down a hill, right? It picks up more and more snow as it rolls, growing bigger and bigger.
Oh, okay, I see. So instead of just earning interest on your initial investment, you're also earning interest on the interest you've already made.
Exactly. That's the key. And that's how, over time, even small amounts can grow exponentially.
So it's like the longer you let that snowball roll, the bigger it gets.
Precisely. Time is a huge factor here.
The book actually highlights this really interesting scenario about investing just $5 a day. Can you walk us through that?
Yeah, so this scenario really illustrates the power of starting early. Okay, imagine this. You invest just $5 a day, starting at age 25, and let's assume an average annual return of 8%. You could end up with, get this, over $600,000 by the time you reach retirement age 65.
Wow. Okay, I'm definitely rethinking that daily latte now.
Right.
But what if, you don't start at 25? Like, what if you're a little older when you start investing?
Well, that's where it gets even more interesting. Let's say you start that same $5 a day investment, but you wait until you're 35. Instead of over $600,000, you'd end up with around $250,000 by 65.
Still a good chunk of change,
A
but
big difference, right?
yeah.
And if you wait until 45 to start, you're looking at about $100,000.
Okay, so the takeaway there is super clear. The earlier you start, the better. Time really is money when it comes to this.
No doubt about it.
You mentioned an 8% average return. Should we all be expecting those kind of gains, though? I mean, that seems pretty high.
Right. It's important to understand that the 8% is a historical average for the stock market. The market goes up, it goes down. There will be years of higher returns and years of lower returns. It fluctuates. But, over the long term, history has shown an upward trend overall.
Okay, that makes sense. So we've kind of gotten a grasp on how compounding works, but how do we actually put it to work for us? What are some actionable steps we can take?
Well, the book gives some really good advice on this, actually. The first thing, and probably the most important, is to just start. Start early.
Yeah.
I know we've talked about this, but it's so important that it's worth repeating.
It's like that saying, the best time to plant a tree was 20 years ago. The second best time is today.
Exactly. Even if you can only invest a small amount right now, the earlier you start, the more time your money has to grow and compound.
Right. So procrastination is definitely not our friend when it comes to compound interest.
Not at all. Another crucial tip is to reinvest your earnings. Let's say you own stocks that pay dividends. Don't just pocket that money, reinvest it. That way, you're earning interest on your initial investment A&D on your earnings. It's like you're pouring gasoline on the fire.
Oh, okay.
It keeps that snowball rolling.
So it's all about maximizing that growth.
Right. And there's actually a specific mechanism for this called a DRIP, which stands for Dividend Reinvestment Plan. A lot of companies offer this, and it basically automates the process for you.
That's pretty handy. It brings up another important point. Consistency. Is that a big factor here too?
Consistency is key. Think of it like building any other good habit. You want to make investing a regular part of your routine. And you know what? There are a ton of apps out there now that can help with this. Acorns, Robinhood, just to name a couple. They let you invest small amounts regularly, and you can even set it up to happen automatically.
Oh, that's awesome. You don't even have to think about it.
Exactly.
So you've given us some great tips.
Yeah.
Are there any, traps that we should try to avoid when it comes to all of this?
Definitely. One of the biggest pitfalls is withdrawing money early from your investments. Try to avoid doing this unless it's a real emergency, because every time you withdraw, you're basically hitting the pause button on that compounding process. You're taking money out of that snowball.
Got it. So patience really is a virtue when it comes to investing. Speaking of investing, are there certain types of investments that are better suited to this whole compounding thing?
Yeah, that's a good question. When it comes to compounding, you really want to look for investments that have the potential for solid long-term growth. Mutual funds, index funds, ETFs, those are good options to consider because they offer diversification, which means you're spreading your risk across a bunch of different assets. And they tend to provide more stable returns than individual stocks.
Okay, so less risk, more stability.
Exactly. And don't forget about retirement accounts. Those often come with some nice tax advantages that can give your compounding power an extra boost.
Oh, right. Tax advantages are always a good thing. So
Ooh.
it sounds like we've covered a lot here today. To kind of bring it full circle back to that $5 a day scenario, if you follow these tips that we've talked about, starting early, reinvesting your earnings, staying consistent, not withdrawing early, and choosing the right investments, you're basically setting yourself up for some pretty amazing results.
Right.
Absolutely. And even if $5 a day just isn't realistic for you right now, any amount that you can invest consistently combined with these strategies can really put you on the path toward building a solid financial foundation.
This has been incredibly helpful. So the main takeaway, I think, is that compound interest isn't just some abstract financial concept, It's a powerful tool that anyone can use to really build a more secure financial future for themselves.
Couldn't have said it better myself. And one final thought, I'd encourage you to maybe do a little research into historical market returns. Look at past trends, both the good times and the bad times. It can give you a more realistic perspective on the potential and, of course, the risks of long-term investing.
That's a really great point. It's all about being informed and making smart choices. And remember, you have the power to shape your financial future. Even small steps taken today can lead to big rewards down the road. Thanks for joining us today.
Thanks for having me.